Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 9th, and welcome to the In the Know Trader Show. Well, we finally have a down day in the market, at least as of now, as we record late morning Eastern Time. The S&P is down about 21 points, 66 basis points or so, 0.2%. It was down well more earlier in the day, so it's come back somewhat. Oil is virtually unchanged on the day from its 2:30 settlement price yesterday at just about 38.15. Gold has a good update today. It is up about $19 in the August contract to 17.24. And yields have backed off again from the big move they had last week. The 10-year is trading at 82 basis points, down from, I guess it was about 95 or so that we hit last week on the high. So we'll talk about that a little later. As far as what we're going to do today, we'll do our overview of the markets like we do each week. This week, in the trader education portion, I'm actually going to answer some questions that have been asked of me in the last week or so since the last show. And I will tell you that that's one of the ways that you can get some things answered yourself is write me, and I will try to answer questions that are appropriate for the show. So if you say to me, Rick, what do you think of stock XYZ? Then I'm not going to answer. But if it's something that's more general in nature and certainly can help educate other people, I will do that. So we will do a Q&A session today with a few questions. And then this week, the sector analysis is going to focus on the banks, both money center banks and the big regionals. So you'll see there's about a dozen names down there that we will try to get to. And these are some of the most popular big name banks, and we'll see what they're doing as of recent. Of course, given what yields have just done, having moved up, so the 10-year moved up from, let's just call it 60 basis points or so, give or take, to as high as 95 last week. That is a widening of the yield curve. We will talk about that too, and it's certainly been positive for the banks. So that's what we're going to do with today. As a reminder to contact me, it's rick@intheknowtrader.com. That is my email. And it's, of course, to go to our website, intheknowtrader.com. You can sign up for our weekly report, which is called the Tactical Trader Report. So it is generally more short-term oriented, usually weeks to months that we hold stuff. Very rare for us to hold things beyond several months, and it is not meant for investing. It is more for trading, but it is definitely not for super short-term trading. So if you are a day trader or someone who likes to be in and out a few times over the course of the week, the ideas that we generate in that newsletter are more to, hold a few weeks to a few months. So just so you get a sense of that. And of course, the whole reason I started In the Know Trader was to give you, the public, much more access to institutional-oriented market analysis and looking at the ways institutions actually trade versus the way the common kind of individual trader does. And there are very different tools and ways of looking at markets than some of the basic tools that individuals use. So that's what I show you in that analysis and talk about in these shows too, that we do each Tuesday. Let's start off, as we do each week, by comparing the relative performance of the 11 macro sectors in the S&P and how they've moved over the prior week. If you see a red dot or a green dot above or beneath any one of these sectors on the right-hand side, that moves, the red dots means they have fallen more than 1% versus the S&P since last week. And green dots mean they have moved up more than 1%. And last week we didn't have a heck of a lot going on. This week there's lots going on. So what do we have there? Looks like 10 of the 11 sectors have moved at least 1% versus the S&P in the past week. So let's start off on the what's underperformed in the last week. Well, communication services, the second one from the left in the bold green, is up about 5.7%. It was up over 7.5% last week. So that's come off about almost 2%. The technology sector continues to slide. It is still the best performer on the year. Easy to see that, almost by double anything else. But it is now only up 11.7% above the S&P's performance year to date. Last week, it was up over 12.8%. Big gainer, well, actually, let's finish off the red dot. So staples went from being slightly up versus the S&P to being down over more than 2.5% as of last night's close. That makes sense as the market has continually moved higher. Having the safety of consumer staples is not what most portfolio managers and individuals have been going after. They rather go for the growthier, more high-flying names, and therefore you're seeing staples underperform. Healthcare has also given back and is now the fourth best performer. Earlier this year was third, and even at one point the second best performer. So it's still an outperformer, just not as much. So that gave up some territory last week. Utilities went from virtually unchanged to down almost 2%. So those are the losers. And now as we take a look at what outperformed, industrials had a significant up move last week, gaining about 400 basis points. That's another way of saying 4% versus the S&P. So it's still down on the year. And it is the third worst performing group, but a lot better than it was recently. Materials had gained a bit last week, a little over 1%. The big one with the big dot is energy. So I'll try to do this also going forward each week. Is I'll show you the standout group, the one of the 11 that has moved the most. And over the past week, this has gained over 700 basis points. So it is still the biggest loser year to date, but now it's only down a little over 20% versus the S&P. It was down almost 27.5% last week. And as a side note, if you've been listening to this podcast and if you get in the No Trader, you will know that in, I think it was the middle of April, I upgraded the energy sector. And since I upgraded the sector through last Friday's close, it has outperformed the S&P by 2,000 basis points or 20%. So it has been a spot on call. We got it almost on the low of the year when I upgraded the sector in relative terms to the S&P, and it has been so far a complete home run. If you can pick a sector that moves 20% in a couple months relative to the market, and you play that one correctly, that is a home run. In fact, that has me think about also that I am in the final stages of coming out with a new In the No Trader product. It will go over the 11 sectors, and it will tell you which ones to be invested in. So if we use the 11 ETFs, the SPDR ETFs, which are some of the most liquid ones out there, if you can be in the ones that are going to outperform the market and avoid the ones that are going to underperform, you can clean up versus just being in SPDRs themselves. So we're coming out with a new piece. I'm hoping to have this launched on July 1st. So in the next couple of weeks, I will hopefully finish doing everything I need to get that prepared. And in the couple of shows that we still have left in June, before July starts, I will fill you in and let you know if we're on target for July 1st. I will put up more information on In the No Trader on pricing. I had some pricing there. I'm still working out pricing, and some also a special deal for those of you who currently get In the No Trader's Tactical Trader Report. If you subscribe to both reports, I will give a discount to compared to the regular price of buying any one individually. So some good incentives there to get that new report that comes out. And it will be, again, about playing the big ETFs that represent the 11 macro sectors and my opinions on which ones to be in, when, and where. So that's also not a quick trade. So we're not going to generally be in and out in a week on something. That's not what I'm looking to do. It's looking to kind of catch new trends and focusing on the right sectors to be in that are going to make you more money than simply being long the S&P. To finish off this slide, financials had a good week too. They were down 17% last week. As of last night's close, they're only down 12.44% versus the S&P. So still the second worst performer this year. But with the interest rates having shot up late last week, you are seeing a flight into financials because as interest rates move higher, that is good for the banking sector. That's how they make money, is when interest rates are high, as well as the fact that when the short end is near zero, as it is now, and the long end of the curve moves up, that is the biggest and easiest way for banks to make money, because they themselves borrow short-term and lend long-term, and they pocket the difference. And that is the beauty of the banking industry. So when the yield curve is flat, they can't make money, or they can't make much money. When it widens out, they can. And one of the things that I noticed yesterday, I think it was Morgan Stanley came out with a call to say that they expect the yield curve to widen. Well, with interest rates on the short end at zero, basically that call is nothing more than saying we think that the 10-year is going to go up, and that essentially the 30-year will go up in yield terms more than the 10-year. But that's nothing more than a call that says they expect rates, and let's use 10-year as the benchmark, that 10-year rates are going to move higher. And that call comes kind of after they just shut up 30 basis points. So it's I wouldn't call it a very prescient call. So far, the 10-year stopped where we said it would initially, which was the mid-90s. And we'll need a further breakout over 1% to think that call is right. Meanwhile, as I said, they've backed up to already down to 82 basis points. All right, let's get to some charts. And just quickly with the S&P. So again, I've shown this to you multiple times. This pink zone in here has been the area that we've wanted to sell into to lighten up long-term exposure in our portfolios. And I've gotten some emails relating to this saying, now that you're losing money because we've gotten above 31.75, what are you going to do? And the answer is we have not lost any money. I have told you to lighten up long exposure into that zone. I did not say go short. I do not need the market to come down to make money on a short, because we're not short. We're simply saying, given this picture, never in the history that's almost 100 years long that the S&P has been trading has this pattern of higher highs and lower lows here on the left half of this chart, had the bottom come and instantly turn around to make new all-time highs. So here I drew a trend line that is nothing more than theoretical, signifying that I expect that somewhere up in here, we will peak and pull back into the zone before potentially moving higher over time. Now, the fact that it's never happened in the 100 years or so that the S&P has been around doesn't mean it can't happen now, and that we just keep going and make new all-time highs. We can. There's lots of things that have happened in the last few months that have been the first time in history. The move off of the March low already is the fastest move in history, from a low, given how much we've moved up in percentage terms. So whether it's in 50 days or, any way you want to count it, the move up is the fastest move we've seen. So lots of things have had record moves. So look, I could be wrong and we go and make new all-time highs and this thing could keep going. It's never happened. And given the fact that, well, here's something for you. Yesterday, the World Health Organization announced that on Sunday, the prior day to yesterday, 136,000 new cases of COVID-19 were marked across the globe. 136,000 new cases, the single highest amount of new cases since this whole COVID thing started. So for all the people who say we're done with this, people are coming out, businesses are open. Yes, that's true. People are coming out, businesses are open. Yet Sunday had the most amount of COVID illnesses, new COVID illnesses in the last 6 months. So this thing is not gone. And to me, I've been quite surprised to the degree at which this has gone recently. I certainly didn't, I expected it to get up here because for a couple months we've been telling you, as we get north of 3,000, that's where you want to lighten up. Because yes, I am assuming, and I know you cannot always assume and be correct, I am assuming that this market will not just scream to new all-time highs. Even though NASDAQ did, I don't think the S&P 500 was going to do that without getting into this zone and doing some type of pullback such that you could buy back lower what you've been lightening or decreasing exposure in here. If we go higher, what's the cost? The cost is opportunity cost. Because if you sold out of some stocks here and you have to put through and you replace those stocks at a higher level, then you didn't lose money, you simply didn't make as much as you could have. And I think you have to realize that, so that some of the emails that I get about, well, you know, we've blown through your zone, what are you going to do now? Well, yeah, we're higher than I thought it would go. We're not by much. The S&P right now in real time is at 3208. And I said sell up to 3175 into this zone of 3,000 to 3175. So it's 1% or so past the high end of the range. I'm willing to live with that on the chance that the enthusiasm for stocks is overdone, is not necessarily the correct thing given that this virus is still very much here. The one thing we know for sure is that the Fed will backstop the markets from getting crushed again, which is, and I kind of had that feeling even before the Fed told us that, but shortly after the March 23rd low was put in, and for those of you who watched me, you'll know that on March 23rd, it was on Bloomberg TV before the markets opened, and I said, yes, I am buying right today. And then again, we bought on April 2nd, which was the secondary low. I've been saying continuously that these lows would not be taken out this year. But on the flip side of that, I also said these highs would not be taken out this year. And we will see. Only time will tell here. But I am just not enthusiastic about buying into this type of rally at this point, such that I am much more comfortable being a seller up in here. Given history, given that this pattern has never come back and from higher highs and lower lows to come instantly back and make higher highs in this short amount of time. So it's a combination of 40 years of experience and 100 years of history or so that has me willing to be a seller up into this area. So that's that with the S&P. Let's quickly look at a couple of other charts before we move on to other things that we need to do. Here's the 10-year. Here's the daily chart. We had told you that if it got above 76 basis points, that it would go and test first. I think it was 91. Here, let me put the TDST line. Yeah, so we said 93.8 and then 97.7. So we kind of stalled right up into there. You're back in. Well, you never even got above the cloud. You're still in the cloud here. Be interesting to see if we pulled back enough to even test down towards the bottom end again. Obviously, that should be very strong support. But right now, I would say between today's low and even just a little bit beneath that, so somewhere around just between, let's say, 76 and 80 basis points should be initial support, and that's what we're seeing now. Let's look at let's look at GDX. So we have been bullish gold stocks. Here's that rounding 6-year bottom that broke out to the upside, stopped against propulsion exhaustion levels, actually full exhaustion levels, pulled back to the breakout point and have started to move up again. You know, so I do like this. I'm willing to sit with this all the way down to Well, at least 2966. It's not going to change my call if we break under the breakout point, but I wouldn't want to see it get much under there. And my guess is these are probably still not really over-owned yet. You have a 6-year base to this, so plenty of selling took place to offset, obviously, all the buying that came in. So this is still a sector I like. And let's see, is there anything left here that I want to do? All right, so I'm going to go now to the Q&A part. So we talked about trader education, and we're going to take a look at Q&A. So one of them was just a general question about commodities. Now, commodities in general have been, as an investment, they're a really tough segment of the market to make money with over time, especially when it's when the gauge of the commodities is the futures contracts themselves as compared to an underlying index. Because most futures markets are in what's called contango. In other words, each month out that the contract goes for a commodity is usually priced higher than the closer months. So, for instance, July oil is trading at a lower price than, let's say, December oil. So, and that's typical for gold and silver and copper. Most things, most of the time, that's how the futures markets work. The farther out you go, the higher the price. So that as each month, as you have a contract expire, the portfolio manager needs to buy the next contract, and that's always higher price. So there's always a loss each time you roll. So investing in commodities are hard. One thing we can look at is something like GSG, which is the Goldman Sachs Commodity Index. All right, so this is an ETF that tracks the index, and you can see this going back, many, many years now. It's a weekly chart. So here's the total trading history. So look, there are bull markets. 2007 into 2008 was huge, but then the world fell apart in 2008, and they crushed commodities. And you can see, this is not an asset that moved anything close to what the S&P does. And then in 14 and 15, they fell again. And now, when we had the COVID sell-off, it has fallen again. So this is a tough sector to play as an investment. And generally, there is a bearish, what's the word I need? Skew to the way this thing trades. So I can't tell you if the low we made, 6 weeks ago is going to be the bottom to this thing. In theory, you still have a ton of overhead resistance. Commodities as a group collectively are tough to invest in, as are individual contracts, but they're certainly trading instruments, and I trade them almost every day. But when I hold something more than a week, it's a lot in commodities because you're usually making or losing money so quickly that these are highly leveraged instruments. They're definitely not for everyone, and I would tell you, don't really venture into this segment of the market if you are not a truly professional trader. You stay away from the commodities markets. Another question that came in had to do with breadth figures and what the advanced decline line is showing. So let me get to, I think I have this over here. Yeah. So one of the questions that somebody said is take a look at the NYAD, which is on StockCharts.com, the ticker for the New York advanced decline line. And let me see if I have that here. Yeah. Now, I don't even know what I have up on these, but let me see. Okay, so this happens to have Ichimoku on it, but it doesn't matter. This is the advanced decline line going back also. It's a weekly going back to the 2010. And breadth over time has been strong, and it looks like it's bottomed again. And this looks very close. It might even have made a new all-time high. The thing is, this is not the breadth indicator I look at. So for all of those of you who use StockCharts.com, and that's going to be many of you because that's how you listen to the podcast in the first place, is because you use StockCharts for your charting and to watch lots of videos, and for all the good things they do. I use this ticker. exclamation point, AD line, New York City, NYC. And what's the difference? The difference is that these are stocks only. If you use the New York Stock Exchange pure advanced decline line, you have instruments in there that are not proxies or not individual corporate stocks. There are warrants, there are ETFs, and there are bond proxies. So you're getting a lot of things that are somewhat misleading and say, oh, what are stocks doing? So this is my preferred way of looking at stocks, and that is at stock breadth. All right, so it's a exclamation point, AD line, NYC, and you can see that the sell-off that we had this year still held the major uptrend line from the early 2016 low. Looks like we've just surpassed the downtrend line for a high, so it's very possible this turns and makes new highs. And if that's the case, then I may very well be wrong about my call that the S&P won't make a new high this year. And I'm willing to be wrong, but it's, that's this game. You're right, you're wrong, and hopefully you're right a heck of a lot more times than you're wrong. But that is the simplistic way of thinking about things. You put on ideas and strategies, and some of them are right and some of them are wrong. And time will tell if I'm right that selling up into where we've been selling will pay off. So that's that there. Now, I realize we've got only about 2.5 minutes left, which makes me think that, well, it tells me that I've talked a lot about other things and we're not even going to get to the bank stocks this week. So what I am going to do is say, we will get to those next week. And in fact, I'll get to those names before we even do the trader education part next week to make sure, we cover some individual names for you. So next week when we do the podcast, I will go through those dozen or so money center banks and top regional banks so that you get insights into key levels to look at as you're possibly positioning yourselves into that group. So then the last quick question that somebody had for me was, now that value is outperforming growth, tech is underperforming. And when the person was telling me tech's underperforming, that's only recently, right? We looked at tech is still the best group this year. It's just been not nearly as good as it was a few months ago, as there's been some rotation. So the question was, is the fact that value is doing better than growth and tech's underperforming, does that mean we're at the beginning of a new, longer trend in, well, the person said new, longer trend, and I'm not sure if they mean to the market in general or the fact that is value over growth. So let me see if I can quickly find, I think I have a value versus growth chart set up. Let's see. Oops. Well, here we go. Let's see. There it is. Okay. So this chart is showing growth over value. And the fact that it's coming down says that that value has actually been outperforming growth up until this week, recently. And is this the beginning of something new? And the question is, it's a little too early to know. So I'm not going to commit either way. I just don't know yet. But the fact that MACD is getting close to crossing, we certainly had some type of exhaustive move. Value may still be something that which means you'd look at this upside down in the sense that, I would look for value to potentially outperform growth. I'll go over that next week too. I'm sorry, we're out of time. That's it for this week. I'm Rick Bensignor, and you've been listening to In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.